All right, let's just jump right in. We're going to try and unpack one of the biggest and honestly most baffling mysteries in the tech world right now. How is it that one of China's most important strategic tech assets, a real titan in cloud computing, is somehow valued at less than zero?
And yeah, that quote says it all, right? That is the actual shocking verdict from the market. And no, that's not an exaggeration. Think about it. Alibaba has poured billions into this cloud division. They've built it into an absolute powerhouse. And this is the thanks they get from Wall Street. It's a brutal, almost unbelievable assessment. And it sets up this huge contradiction.
So that really brings us to the core question we're trying to answer today. How is this even possible? It just completely defies basic business logic, right? So what we're going to do is piece together all the clues, the financial ones, the political ones, the strategic ones, and see if we can solve this really, really strange puzzle.
Okay, so let's start with the math because it's pretty absurd. This whole less than zero problem. Here's how it works. You take Alibaba's total value, right? Then you subtract the value of its other businesses, the e-commerce stuff, the logistics, and what you're left with for the cloud division is a negative number. It's genuinely bizarre.
This analogy just hits the nail on the head. It perfectly captures how absurd this whole thing is. Imagine someone gives you a free Lamborghini. Awesome, right? But then you find out the insurance costs are so high that they actually make you poorer. That's exactly what's happening here. Investors are looking at this incredibly powerful, high-performance asset and basically saying, nope, the risk of just owning this thing actually subtracts value from the whole company. All right, so to really get why this is such a paradox, we have to look at the evidence on the other side. Let's dig into the numbers that, on paper, should make Alibaba Cloud an absolute giant. First off, just look at the sheer scale of this thing. We're talking about a business that pulls in $13 billion a year in revenue. This isn't some tiny experimental side project. No way. It's a massive, fully established operation that's making serious money.
And it's not just big, it's dominant. Inside the massive Chinese market, Alibaba Cloud has a staggering 40% market share. It's the undisputed leader, way ahead of anyone else. So you've got scale, you've got market leadership, and yeah, the plot is definitely thickening here.
Now, just for a second, let's compare this to its global equivalent, Amazon Web Services, or AWS. AWS is the engine that drives most of Amazon's entire premium valuation. But Alibaba Cloud, which is basically the AWS of China, somehow has a negative impact on its parent company's stock. The numbers just don't add up. So what on earth is really going on?
All right, this is where we get our first major clue. And spoiler alert, this isn't really a story about spreadsheets and earnings reports. This is about the massive political elephant sitting right in the middle of the server room. Turns out, geopolitics can completely, and I mean completely, override financial fundamentals.
So pressure number one is coming from Washington. U.S. sanctions are actively throttling China's access to those cutting-edge NVIDIA chips, the ones you absolutely need for advanced AI. This basically starves Alibaba Cloud of the fuel it needs to compete in what is, by far, the most profitable part of the market, high-margin AI workloads. Now, at the very same time, there's immense pressure coming from inside China. Beijing has incredibly strict rules about data security, which gives the government legal authority to just access data on the cloud. So for an investor, this creates a giant question mark. Who's really in control here? Is it the company or is it the state? And those two pressures combined create a third really big one, a global trust gap. International customers are understandably pretty hesitant to host their sensitive data on a Chinese cloud. So its total addressable market just shrinks. Not because the tech isn't good, but purely because of that political risk.
Okay, the next big piece of the puzzle actually came from inside Alibaba itself. It was a single corporate decision that took all those abstract fears investors had and made them terrifyingly real.
So, back in 2023, Alibaba announced they were going to spin off the cloud business. This is a classic Wall Street move, right? You do it to unlock value for shareholders. And investors, they loved it. But then, just a few months later, the spin-off was paused indefinitely.
It was shocking, and the message to the market was crystal clear. This cloud business isn't a normal free market asset. It's a strategic political asset, and the party, not shareholders, gets the final say. So, you take all these clues, the geopolitics, the canceled spinoff, and you ask, how does that possibly add up to a negative value? Well, it all comes down to this idea that Wall Street has, called the China discount. It's this concept that tries to explain why a dollar earned in China, well, it just isn't worth the same as a dollar earned somewhere else.
And because of all these risks, the market's perception has done a complete 180. Investors don't see the cloud as a growth engine anymore, not like AWS. Instead, they see it as a cash-burning subsidy, a liability that the other profitable parts of Alibaba are forced to prop up, with huge costs and no clear way to ever expand globally.
And that brings us back to this idea of the China discount. Now, it's not some official term you'll find in a textbook, but believe me, it is a very real thing on Wall Street. The best way to think about it is like a risk premium that investors slap onto Chinese companies, just to account for all the uncertainties that you just don't find in other markets.
So, what are the ingredients that go into this China discount? Well, you've got worries about weak accounting transparency, there's the perpetual risk of getting delisted from U.S. exchanges, and then there's the big one, the precedent of state interference, like what happened with Jack Ma. That sent a very powerful message. At the end of the day, the party is in control, not the shareholders.
Which brings us to the ultimate paradox for any investor looking at Alibaba today. Is this whole situation a hidden gold mine? You know, a brilliant asset that's just temporarily undervalued? Or is it a landmine just waiting to go off?
You can really see two completely different futures here. You've got the bull case, the gold mine scenario where all this political stuff stabilizes, the sanctions ease, and investors suddenly re-rate the stock, giving the cloud a huge positive value. Then there's the bear case, the landmine scenario, where tensions get worse, the chip restrictions stay, and this thing becomes a permanent financial drain on the company. It is a massive gamble either way you slice it.
And this really leads to a final, pretty provocative thought. An investor buying Alibaba's stock right now is essentially getting the entire cloud business for free. In fact, you could argue they're being paid to take it. But, as this great quote puts it, sometimes things are free for a reason. And the ultimate question is whether this free Lamborghini is a priceless opportunity or if it's infested with bedbugs. And for now, it seems like the market has made up its mind.